Dear investor, Edelweiss Private Wealth Management is pleased to present you the latest issue of Investment Strategy Report for May 2020. Let's take a look at key highlights of April 2020. The current health crisis is leaving its footmark globally, which has begun to show in drastic fall in economic activities worldwide. It is reflected in plummeting demand of crude oil in US, causing surge in stockpiles and as a result, crash in oil prices. In the US, the jobless claims over the past 5 weeks have surged to a record 26 million, erasing most of the jobs that were created post the 2008 global financial crisis. Even in Euro area, manufacturing and services PMI across several nations posted a huge contraction in activity. Chinese GDP fell by almost 7% in the first quarter of calendar year 20. Chinese economy experienced such a contraction for the first time in several decades. India manufacturing PMI declined over the uncertainty as the manufacturing activity hit a 4-month low. The effect of lockdown has started to show as services PMI slipped below 50. RBI announced a slew of monetary policy measures like targeted TLTROs, cut in reverse repo rate, and special financing facilities to NABARD, SIDBI, and National Housing Bank in order to counter the current financial crisis. Equity view. Nifty registered a growth of 14.7% in April. This is the highest monthly gain witnessed by Indian equity market since May 2009. India's market cap to GDP ratio currently stands at 62% after touching a low of 49% in March 2020. Comparing it against its long-term average of 76% indicates that the markets are reasonably undervalued. As observed in the past, steep falls in equity market are typically followed by a sharp recovery. As soon as the current crisis ends, the focus will return to fundamental factors like earnings and economic recovery, which would decide the future course of the market. In the current market scenario, we advise to maintain neutral allocation to equities. Despite a 25% rally from the lows hit during March 2020, valuations are still attractive from a horizon of 3 years and beyond. However, with corporate earnings likely to take a hit due to nationwide lockdown, possibility of market corrections cannot be ruled out. Fixed income view. Lockdown has led to cash flow problem for multiple businesses, resulting in increased debt obligation pressure, especially for issuers with low credit quality. Due to heightened anxiety, investors preferred to exit certain debt mutual fund categories like credit risk funds and medium duration funds. In the month of April, these two categories witnessed total redemption of Rs 23,000 crores. In its March policy, RBI had announced 3 months moratorium to all loans outstanding as of 1st March 2020. It is now clarified that the 90-day overdue period to classify an asset as NPA will start post-moratorium period. It brought a significant relief to the borrowers. Given the precariously low economic activity, compromise on credit quality is unwarranted. It is advisable to realign debt portfolio to higher quality credit exposure either through direct bonds or mutual funds.